Imagine a world where a single accident, a fire or a storm, could wipe out everything you own, and there would be no backup, no safety net, no second chance. That was the reality for people hundreds of years ago. The concept of insurance didn't start as a business, it started as a survival strategy. Let's go back to ancient times. Traders used to travel long distances carrying goods by sea, but the journey was risky. Storms, pirates, and shipwrecks were common. If a ship sank, the trader would lose everything. So, what did they do? They came up with a simple but powerful idea. Instead of one person taking all the risk, a group of traders would agree to share the loss. If one ship sank, everyone would contribute a small amount to cover the loss. This was the earliest form of insurance, risk sharing. Fast forward to ancient China. Merchants would distribute their goods across multiple ships instead of loading everything onto one. That way, even if one ship sank, they wouldn't lose everything. Again, the same principle. Don't put all your risk in one place. Now let's move to ancient Babylon around 1750 BC. There was something called the Code of Hammurabi. Under this system, if a merchant took a loan to fund a shipment and the goods were lost, the lender would cancel the loan in exchange for an extra fee. This fee was basically an early insurance premium. So slowly, the idea evolved from sharing losses to paying a small amount to transfer risk. But the real turning point came in London during the 17th century. At that time, London was a major trading hub. Ships were constantly moving in and out, carrying valuable goods. But again, the risk was high. There was a coffee house owned by a man named Edward Lloyd. This place became popular among ship owners, merchants, and investors. People would gather there to discuss shipping routes, risks, and deals. Here's where things got interesting. Investors would agree to cover the risk of a ship in exchange for a fee. They would literally write their names under the details of the ship and the risk they were taking. That's why they were called underwriters. This coffee house eventually became the foundation of modern insurance, known today as Lloyd's of London. Now insurance started becoming more structured. Then came another major event, the Great Fire of London in 1666. The fire destroyed thousands of homes and buildings. People realized something very important. Disasters can happen anytime, and the financial damage can be massive. After this, fire insurance companies started to emerge. People would pay a fixed amount regularly, and in return, they would get compensation if their property was damaged by fire. This model slowly expanded. Life insurance came next. In the beginning, it was simple. People would contribute money into a pool, and when someone died, their family would receive financial support. Over time, insurance became more advanced and organized. Companies started calculating risks using data, probability, and statistics. Premiums were decided based on age, health, profession, and risk level. Today, insurance covers almost everything: life, health, vehicles, homes, travel, even gadgets. But if you look at the core idea, it hasn't changed. Insurance is still about one simple concept: protecting yourself from financial loss by sharing risk. You pay a small amount today so that a big, unexpected loss tomorrow doesn't destroy your life. It's not just a financial product, it's peace of mind. Because at the end of the day, we cannot predict the future, but with insurance, we can prepare for it.